Hi, and welcome to the ECIO market commentary for the second quarter. The second quarter was a great quarter for investors as US stocks were up 4 to 20%, overseas stocks up 10 to 24%, and fixed income results up 4 tenths to 7 tenths of a percent. That's resulted in a year-to-date returns of 10 to 20% for stock investors and a more modest 0.4 to 0.6% for fixed income investors. Overall, the past 18 months has been a great period for investors, although it has been volatile. First quarter of 25, we saw the tariff concerns leading to 20%, nearly 20% downdraft. This year, in the first quarter, the Iran war led to about a 9% downdraft. Still, very robust returns over the long term. Past 12 months, S&P up 22%, and the 3-year annualized return up over 20% per year. From a sector perspective, technology stocks led the way higher. This was a reversal from the first quarter when technology stocks were negative. Energy stocks, conversely, down 13%. Again, in the first quarter, energy stocks were up about 38%. All in all, equities had their best quarter since 2020. And if you recall, that was the period of COVID. This was largely driven by a resurgence in the AI trade and a relief rally over geopolitical tensions in the Middle East. Small cap stocks reached record highs, signaling that investors still believe the U.S. economy is intact and that the labor market will remain strong. On the fixed income results, bonds were modestly positive, driven by interest income, as longer dated interest rates actually moved up. On the economic and geopolitical front, we saw some relief from the Middle East tensions. Energy prices came down as the ceasefire went into place. That obviously is on again, off again, so more to come on that front. The Fed's position has shifted. Where the market was expecting the Fed to potentially cut, the market is now pricing in the Fed on the sidelines or even increasing interest rates this year. What's really driven the market has been strong corporate fundamentals, in particular earnings growth. Year over year, the S&P 500 earnings growth number is up over 23%. So very robust, in excess of what analysts had expected. The biggest pause in the market has to do with inflation. So sticky inflation driven by high fuel costs is the biggest concern and has resulted in both consumer and business sentiment reaching multi-year lows as consumers have cut back pretty dramatically, particularly in discretionary spending. So as we look forward, we think the market will be primarily focused on corporate earnings and whether or not those can be sustained, and also inflation and whether or not the inflationary pressure can abate. So that's a quick recap of the quarter. Since it is quarter end, I'm going to go through some of these in more detail. If you have a few minutes, stick around. We'll start with earnings growth in the S&P 500. Here you can see the year-over-year earnings growth for 2026. That number is now forecasted to be 24%. So that's up from what analysts had expected. Additionally, in 27 and 28, expectations are for very robust earnings growth. That's been driven primarily by large profit margins in the S&P 500 companies. So about 15% is the expectation for the second quarter of this year. Looking at performance of the S&P 500 and the so-called Magnificent Seven, which are those big technology companies, what we've seen in 2026 so far is a little different scenario. So while the S&P 500 for the 6-month period has gained about 10%, the 493 companies outside of the Mag 7 have driven that. So those companies are up about 15%. The Mag 7 companies themselves are actually about flat. So diversification in portfolios is starting to pay off as the market gains now are being driven by other aspects within the market. When we look at the concentration of the S&P 500, the top 10 names now comprise about 37% of the market and are driving about 1/3 or 33% of the earnings in the S&P 500. Looking deeper at the AI related component of the S&P 500, there are different subcomponents that we can break the AI trade down into, from hyperscalers, which are the Googles and Amazons of the world, semiconductor or chip companies, hardware companies, power companies and software companies. Overall, about 50% of the S&P 500 is levered to artificial intelligence. You can see the price return for those different industry groups year over year. So what you'll notice is the hyperscalers actually in negative territory. The other notable group is the software companies, which are down about 20% year to date. Conversely, when we look at earnings growth, you can see earnings growth has been very robust, really across these industry groups. Even software earnings growth is up about 19%, despite the fact that those stocks are down 20%. When we look at the capital expenditures on AI, these are the big spenders, the top 5 so-called hyperscalers. This year, we're expecting them to spend $760 billion. This number is up from the beginning of the year where that expectation was around $600 billion. And then you can see leading to almost $1 trillion in annual spend is the expectation from these companies. Where's that money coming from? When you look at those hyperscalers, this is their operating cash flow. So they're generating a lot of cash flow. This is their capital expenditures. So you can see they weren't spending much up until recently. This acceleration is all tied to AI. So the projections are that these companies are going to spend nearly all their operating cash flow on reinvestment in CapEx for AI. That in turn has resulted in this gray line, which is their free cash flow. That being the amount of cash flow they're not spending is expected to come down to near zero. Now, there is good reason for spending that money. And when we look at AI and how effective it has been, it is getting increasingly powerful. These are the different AI models that have been released throughout the years and the corresponding tasks that they can do and how much time it takes a human to do that. So over the past early years, what you saw is AI really couldn't do things any faster than a human. That's changed dramatically over the past 18 months. You see these new models coming up. You see this line going up dramatically. The biggest dot up here is the Claude Mythos model. So right now, that model can do what a human takes about 3 hours to do. So as these models get better and better, you're going to see more and more adoption and more substitution of these models against human capital. So that's resulted in adoption by businesses currently at about 21%. So this number is up. This striped line represents what we expect over the next 6 months. So we expect that to go up towards 25%. And you can see by industry group, different industry groups are adopting quicker. But there's a long ways to go. So we're only at about 20% adoption. In theory, this line will continue to move out as these models get better and better. Turning to inflation, inflation has been a big concern of investors. The latest consumer price index number came in at 4.2%, well above the Fed's target of 2%. You can see this green line is what's driven that. That is the cost of energy. So no surprise, energy costs are driving inflation. You can see that when we look at the price of oil. We came into the year at $55 a barrel. That nearly doubled as the conflict got underway and now is down to about $70 a barrel. So we'll continue to need to see this number come down for the inflation numbers to remain in check. Gasoline prices here in orange for 2026, you can see also hit a high of $4.50, now down at closing in on $3.75 a gallon. As far as the Fed goes, this is the Fed funds rate. This is the short-term interest rate the Fed sets. Currently, we're right here. These dotted lines represent what the market is expecting looking forward in green and what the Fed itself is expecting. So there is a disconnect. The market is saying that they expect the Fed to actually increase short-term interest rates in the near term. And the Fed is saying that they expect rates to remain flat and eventually come down. So we'll see. We would side with the market expectations that the Fed will likely be on hold or even increase interest rates. This is the Treasury yield curve from a 3-month Treasury yield to a 30-year. The light blue line represents where we started the year, and the dark blue line represents where we're at the end of the second quarter. So all in all, interest rates have been moving up over the past 6 months, long-term rates as well as short-term rates. So where does that leave us as we look forward for bond investors? This is a great chart. It shows that today we're starting with a yield of about 4.7% on the Barclays Aggregate Index. If we look at what that forecasts then over the next 5 years, that would forecast a 5-year annual return of kind of 4.5% to 5%. That's largely in sync with what we think investors will see. On the equity side, it's more complicated. Equity returns are notoriously hard to forecast in the short term. One metric we look at is the price earnings ratio over time. So over time, over the past 30 years, investors have been willing to pay $17 for $1 of earnings. Today, the market is priced at about 20 times earnings. So investors are paying about $20 for $1 of earnings. The key factor here in determining whether or not stock prices continue to move up is whether or not earnings growth continues to materialize. And that's really what's driven these outsized returns in equities is very solid earnings growth. So if that can continue, equity results could remain in positive territory. As we look back over the history to 1980, these in gray are the annual return for the S&P 500. You can see 3/4 of the time, 75% of the time, the market has been in positive territory. However, when we look inside of those years, you see these red dots, which represent the intra-year drawdowns. So despite the fact that the market is generally positive, again, about 3/4 of the time, each year you see some pretty significant drawdowns. On average, about a 14% drawdown within the year. Would not be surprising to us if we do see a pullback in equity prices simply because they have been so robust. But from a long-term perspective, we feel investors are well served in maintaining exposure to equities. So that's a quick recap of what happened in the second quarter. If your investment committee has any questions or would like to meet with us, please reach out. Happy to schedule that for you. Thanks for your time and interest, and have a great day.